So where should you invest in 2026? Good luck getting a straight answer. I mean, one minute you hear analysts calling for another incredible year, and the next they're waving these massive red flags. So which is it? Okay, let's dive in and try to make sense of these completely conflicting views.
It really all boils down to this one question. Is this a healthy, growing bull market, or is it a giant AI-fueled bubble that's just about to pop? And what's so fascinating and a little terrifying is that the world's top investment firms, the ones with armies of analysts, they're all looking at the exact same data and coming to completely opposite conclusions.
And this slide really captures the two competing stories perfectly. On one side, you have the bull case, the argument that this boom has plenty of room to run. And on the other side, you've got this much more cautious case, warning that all this AI exuberance is creating some really big risks. Let's start with the bulls.
First up, the optimists. This is the camp that believes the good times are absolutely going to keep rolling in 2026, and they've actually built a pretty compelling argument for why.
Leading this charge is none other than Morgan Stanley. They've come out with a really confident outlook for U.S. stocks, basically telling investors, hey, stay in the market and just ignore all that doom and gloom.
And I love this quote from their senior portfolio manager, Andrew Slimman, because it just perfectly sums up their entire thesis. He's admitting, yeah, okay, we're in the later innings of this bull market, but he is emphatic, this is not the end of the game. So what's got them so confident?
Well, their argument really stands on three pillars. First, history. They point out that in the past, when a bull market makes it this far, the fourth year has always been positive. The momentum is just too strong. Second, you've got the Fed cutting rates, making money cheaper. And third, they're looking at a new wave of fiscal stimulus, something like $170 billion in consumer aid that's about to hit the economy. That's a pretty powerful mix.
But as you can imagine, not everyone is convinced. So let's flip the coin and look at how the cautious camp is seeing 2026, especially through this lens of AI exuberance.
Vanguard is one of the biggest voices in this camp, and their argument is really interesting. They're not saying AI is a fad, quite the opposite. They're warning that the big tech companies building out all this AI infrastructure are about to spend so much money, an unprecedented amount of capital, that their actual profitability is going to get put under a microscope like never before.
And this number, wow, this is what that caution looks like. While the bulls are expecting another great year, Vanguard's 10-year forecast for U.S. stocks is basically flat, an average return of less than 1% per year. It is hard to imagine a more different prediction from Morgan Stanley's.
So why are they so pessimistic? Well, first, they argue that all the amazing profits from AI in the future are already baked into today's sky-high stock prices. Second, they're pointing to history, this idea of creative destruction. Think about it. Today's giants could be tomorrow's has-beens if a new, smarter company comes along. And third, that massive spending we talked about, an estimated $2.1 trillion, could just eat away at profit margins, even for the biggest names in the game.
So that naturally leads to the question, if the biggest, shiniest tech stocks are seen as being so risky, where are the cautious investors suggesting you look? They're not saying to just pull all your money out. Instead, they're suggesting a big shift in focus, maybe toward things like value stocks, solid companies that got overlooked in the mad dash for AI.
Okay, and this brings us to a third way of looking at the market. One that tries to get beyond the whole bull versus bear fight by focusing on something different. These really powerful long-term secular trends. The core idea here is something called secular growth. Now, it might sound a little academic, but the idea is actually pretty simple. It's a trend that's so powerful, so fundamental, that demand just keeps going up no matter what the broader economy is doing. Think about the shift from flip phones to smartphones. That was going to happen whether the economy was booming or in a recession. So what are these powerful cycle-proof trends for 2026? Well, asset managers keep pointing to a few key areas. First, not AI itself, but the picks and shovels needed to build it. Second, the explosion in the commercial use of drones. And third, the huge ongoing transition to renewable energy. Let's take a quick look at each one.
The best analogy for investing in AI infrastructure is the old gold rush. Trying to make a fortune by finding gold was incredibly risky, and almost everyone failed. But you know who made consistent money? The folks selling the picks, the shovels, and the blue jeans to all the miners.
So, the big question for today's AI gold rush is pretty obvious. What are the modern-day picks and shovels, and who's selling them?
Well, the answer lies in the huge infrastructure that's being built to power AI. We are talking about data centers, and these aren't just rooms full of chips from the big names you know. They need this whole ecosystem of specialized hardware, things like advanced cooling systems, high-speed networking gear, power management. This creates a whole universe of smaller, under-the-radar companies that are totally essential to making AI actually work.
Okay, another one of these powerful trends is the rise of commercial drones. And we've moved way beyond them being just a hobby. These are now serious industrial-grade tools. They're being used to inspect things like cell towers, so you don't have to risk a human life. They're used in precision agriculture to make farming way more efficient. And they're even being used in life-saving search and rescue missions. These are real-world applications that are growing like crazy.
And that third secular trend is the global energy transition. This isn't just a nice idea anymore. It's a massive, infrastructure-led investment opportunity. To make this happen, we basically have to rewire our entire energy grid. And a few examples of companies leading the charge here are names like NextEra Energy, which is the biggest renewable power producer in North America, First Solar, a major US-based solar manufacturer, and Vestas, the world's largest maker of wind turbines. The idea here is to focus on the companies that are actually building this new energy grid.
Okay, so we've walked through the optimistic bull case, the cautious bear case, and this third way of looking at things through secular trends. So what is the big takeaway from all this conflicting information?
The most useful approach is probably just to have a clear mental framework. Step 1, understand the bull case. It's built on real economic signals like Fed policy and stimulus. Step 2, respect the cautious view. They're right to be worried about sky-high valuations and the huge costs of the AI buildout. And step 3, try to look past that debate and identify those powerful secular trends, the forces that could grow no matter which side wins the bull versus bear argument.
And that really leaves us with the ultimate question for 2026, right? In a market where even the experts are completely split, is the smart move to bet on the whole economy continuing to rise? Or are the biggest rewards going to be found by focusing on those specific, powerful trends that are designed to grow no matter what happens next? That's the debate that's going to define the year. Thanks for watching.